Before the bell rings, we've got two retail heavyweights painting very different pictures of the American consumer. Dollar General representing the value-conscious shopper, and Best Buy capturing discretionary spending on tech. The contrast here tells us everything about where demand is flowing. Let's start with Dollar General, which delivered a masterclass in execution. They crushed expectations with earnings of $1.86 per share, sailing past the street's $1.58 estimate. More importantly, net sales climbed to $10.7 billion. That's solid 5.1% year-over-year growth that shows real momentum in their core business. But here's what really matters. Same-store sales jumped 2.8%, and that's not just numbers on a page. That's actual foot traffic walking through doors for essentials. When people need basics, they're choosing Dollar General, and management sees this strength continuing. They bumped full-year EPS guidance to a range of $5.80 to $6.30, essentially telling us they're confident about the back half of the year. The market's responding accordingly. Pre-market trading has the stock up around 6% on this classic beat and raise combination. Now flip to Best Buy, which also delivered a clean quarter but with a different narrative. Revenue hit $9.44 billion with adjusted earnings of $1.28 per share. The key metric here is comparable sales, which ticked up 1.6%. It might seem modest, but it's actually breaking a prolonged lull we've seen in big-ticket electronics purchases. Management kept their full-year outlook steady. Revenue between $41.1 and $41.9 billion, with adjusted EPS in the $6.15 to $6.30 range. But there's a cloud on the horizon. Potential tariffs could pressure pricing just as the tech replacement cycle starts waking up. Pre-market has Best Buy down about 2%, but this isn't rejection. It's the market asking for the next catalyst. Whether that's the PC refresh cycle with Copilot Plus integration, a gaming boost, or services and memberships quietly expanding margins while hardware cycles play out. When you step back and look at both companies side by side, you get a crystal clear picture of consumer demand. Dollar General's $1.86 earnings beat on $10.7 billion in sales, with comps up 2.8% and raised guidance pushing the stock up 6%. That tells us the value shopper is being decisive and consistent. Best Buy's $9.44 billion in revenue and 1.28 earnings with 1.6% comp growth and reaffirmed guidance, but a 2% stock decline. That's discretionary spending starting to warm up, but the market wants proof of sustained momentum. So here's the question for today's session. Are you backing the value chain that just raised the bar, or the electronics leader that's tied to the next big upgrade wave? Drop your thesis in the comments. I'll pin the sharpest take and track how these plays unfold at the open.